and welcome back to our first 2022 edition of Amundi's Market Review. Investors had a shaky start to the year with equities down and it's up after the roaring performances of equity markets in December. During the last month of 2021, financial markets actually came to terms with the Omicron variant and European markets eventually recovered previous losses, moving almost 5% up and closing the year with a plus 20%. The Japanese Topix Index was up almost 4%, 11% over the year. In a nutshell, all the value indexes largely overperformed on the broad equity spectrum. The American S&P 500 was up almost 3%, 27% over the year. It is worth pointing out that energy prices were the top performer with plus 20% in December and plus 60% in 2021. Other major asset classes dropped. Long-term treasury bonds and bond yields lifted more than 30 basis points. On the currency front, the US dollar was almost stable versus the euro and the Chinese renminbi, while the greenback depreciated almost 2% versus the British pound and the Japanese yen. Once again, central banks were the main reason behind the sell-off in the bond markets. The Bank of England, the Federal Reserve, the European Central Bank and the Bank of Japan announced that they are ready, to various extents, for a change in their monetary policy stance, positioning to control for inflation. In particular, the Bank of England lifted its policy rate from 15 to 25 basis points, although the country is still in the grip of the pandemic. The Federal Reserve dropped the word temporary relative to inflation. They are now committed to normalize the monetary policy as much as they can. Given the peculiar nature of the recovery and the extremely elevated level of inflation, the last reading as of November was 6.8%, we expect the tightening cycle to be more compressed, without the usual time gap between the end of quantitative easing, the lift-off, and the start of the quantitative tightening. The message has been further reinforced by the release of the Fed minutes in January, with the real possibility for a first rate hike to materialize as early as March. The Bank of Japan and the European Central Bank are entering the same process in a more cautious manner. The Bank of Japan announced the scaling back of its emergency economic support program and the tapering of the corporate debt purchases. As far as the European Central Bank, it will progressively end its emergency measure, the Pandemic Emergency Purchasing Program, the PEP, and the targeted long-term refinancing operation third, and it will reduce its purchases from 90 to 20 billion along 2022. At the same time as a backstop strategy, they will keep on open-ended quantitative easing and will continue to monitor the bank's funding conditions. They eventually confirmed a stable outlook for rates, while inflation in December remained elevated at 4.9%, with significant differences across Europe. On a different note, the People's Bank of China is progressively turning more accommodative via a cut in the reserve rate ratio and in the low and prime rate, with more to come in January. The move was essentially done to discourage further appreciation of their currency. Overall, the key themes for 2022 remain the same: central banks, growth and inflation. In our view, high inflation will be a political and economic challenge that central banks will have to balance with the economic recovery. In terms of allocation, we remain neutral on equity, oil and gold exposure. We continue to actively manage our short duration exposure, being long peripherals in euro and long Chinese bonds, short US treasuries and bond. In the meanwhile, we have been trimming some of the long exposure to credit, maintaining the overweight to European investment grade. Thank you for listening and best wishes for 2022. Please keep safe and see you next time with another Amundi's Market Review.
TMB และธนาชาติเปลี่ยนเป็น TTB เปลี่ยนเพื่อให้ชีวิตคุณดีขึ้น